The S&P 500, the U.S. stock market index, has been soaring to record highs over the course of the last year, but beneath the surface, cracks are beginning to show. The Dow Jones Transportation Average, often referred to as a market barometer, has lagged significantly behind over the course of the last 12 months. And recently, this gap between the broad U.S. stock market and the transportation average has gotten even larger. If we zoom out, you can see that throughout history, such a divergence between the Dow Jones Transportation Average and the S&P 500 has often provided a warning to investors ahead of some big market declines and even a few major recessions, like you can clearly see here in 1973 and 2000. But there have also been instances where the transportation sector has caught back up to the rest of the stock market, like here in 1975. The question today is whether this gap is warning of a major peak in the stock market, or whether we should expect the transportation sector to actually catch up to the rest of the market. If we zoom in on the same example from 1999, you can see that transportation stocks peaked and had started declining despite the S&P 500 continuing to make new all-time highs. By the time the broader market peaked in August of 2000, transportation stocks were already in a deep correction, down 33% from its peak. This kind of noticeable divergence was a sign that the underlying economy was not as strong as the tech-driven rally on the S&P 500 index made it appear, which eventually ended in a recession with stocks declining by almost 50%. In fact, if we rewind to 1973, you can see that the same pattern unfolded as transportation stocks started trending lower from June 1972. This was right before a major bear market where stocks declined by almost 50% as an economic downturn began in 1973. The explanation for this repeating pattern is quite straightforward. Transportation stocks are among the first to feel the effects of an economic slowdown. The use of the transportation sector to predict economic and market trends is something called Dow Theory. And according to it, transportation companies like airlines, railroads, and shipping firms are tightly linked to the health of the economy, making their performance a key indicator of the economy. When the transportation sector of the economy declines relative to the rest of the market, it is often considered as a warning sign. There is one big caveat, however. While Dow Theory looks great on paper for some major market tops and recessions, there's really only a handful of examples throughout history where we see that it actually worked. And even then, even for the moments where Dow Theory did successfully predict a market peak, it didn't seem to do it with a high degree of precision. For instance, remember the divergence that we saw back in the lead up to the 2000 dot-com bubble? This divergence really began in early 1998. From that point on, transportation stocks were signaling economic weakness, but the rest of the market continued to move higher. This lasted for 2 years. As an investor, you may not have liked to be out of the S&P 500 during that entire period. In 1973, Dow Theory was a little bit more precise. The divergence between the transportation average and the S&P 500 lasted only 9 months before the latter peaked and turned back lower. Of course, 9 months worth of a strong market is something that not many investors today have the patience to miss out on. So it's pretty clear from these examples that Dow Theory is not really a very reliable market timing tool for shorter-term traders. The transportation sector is perhaps a better economic indicator than it is a market timing tool. Following it can give us a good idea of the strength of the underlying economy. Typically, you see the Dow Jones Transportation Average decline heading into downturns. There's very few examples where that has not been the case. So when you see this declining, you know you're generally seeing a deterioration in economic trends, and knowing that can be helpful to make better trading decisions. For instance, during periods where the transportation sector is thriving, traders will find success being exposed to cyclical stocks. In other words, stocks that are sensitive to the economic cycle. These booms correspond to market environments suitable for these kinds of companies to grow. Today, we've really seen a period of stagnation since late 2021. The transportation sector has been flatlined. So we have not been in an environment where cyclical stocks are thriving. Traders had to look in areas of the stock market that are not sensitive to the underlying economy. This is why technology and AI stocks have mostly been thriving over this period of time. So while the Dow Jones Transportation Average isn't a great market timing tool, it does provide major insights for traders and should be an index closely followed by anyone involved in financial markets. At Capital.com, we'll continue to provide updates on such market developments. You can trade the transportation index and the S&P 500 on the Capital.com platform. Thank you for watching.